This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
So when does the short-term bounce start? That is the title of Patrick's chart deck. Listeners, you find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, look for the red button that says Looking for the Downloads. Patrick, let's hit it. Page 2. You had the red line in the sand, which you showed us last week, and sure enough, we've broken decisively below it this week. What comes next?
Well, it was 2 weeks ago, but we did have that chart up. And what is interesting is that we talked about the importance of that support line. Essentially, the market had a very typical correction at that moment that was characteristic of what we've seen in the past. And we were highlighting that if it's sort of like an edge of a cliff, and if the market was going to fall off the edge, it had a whole nother level to go down, and that's clearly what has come to fruition. Thing is that we've now reached some pretty oversold conditions in the market, and while I do believe that you and Rosie have merit to your views that something bigger is underway, and that much lower levels in the S&P could come later this year, the reality is these types of bear markets rarely happen in one fluid motion. I mean, we did see that back in March 2020, where it was just one crash to the downside. But often bear markets have big bear market rallies and then sell off all over again. Like you think back to the 2008 to 2009 bear market that lasted like 18 months. There were multiple periods where the markets had declines with huge rallies. And so without saying that the bear market is over and that, in fact, the selling can continue later this year, we're getting oversold enough that a tradable short-term low can emerge. And so the bigger question is what levels does that happen, and where do we go from here? Like that targets of 3,500, what we were highlighting about the 50% retracement of the rally, I think is all in line. And if we did have a short-term liquidity event, wiping out an extra 300-400 S&P points here on the downside in a couple of days would be very typical of that kind of final short-term capitulation of a downswing. And it could happen, but the one thing, if we look on page 3, where I have the oversold condition of this market, now that we gave out that 25 support line, we're now almost as oversold as we were during the March 2020 sell-off from a market breadth perspective. There's still room for it to go down, and hence why I think it might be premature to already say that today is going to be the low. But what I would say is that while lower is the path of least resistance, and certainly can be a violent drop to the downside, I think that we may be, from a calendar perspective, even within a week, see some sort of a tradable bounce. And considering that we have the option expiration next week, where dealers get jammed up with all sorts of gamma, a huge volatility next week, both down and up, is a very realistic possibility.
Going back to page 2, Patrick, that's a pretty darn solid support line that existed there just above 4,100, it looks like. Once we've broken down below that and we get a bounce, do you think that that same level is going to become resistance and that's going to cap the bounce, or would you see a bounce going well above that red line?
Well, if the bounce started today, then no, it will go above there. But if we got all the way down to like 3,600, then that would it would take a 400 or 500 point rally higher on the reaction to get above there. So I think that to make that call, we'd have to see first where the bounce begins. And right now, we know that the sell-off is not yet over. At least at the time of this recording, the downtrend is still quite intact, and new lows are still being made. And so before I make that kind of a call, we'd have to definitely see where the final kind of capitulation short-term low comes in.
Let's take a look at the Volatility Index on page 4. What's that chart telling us?
Well, the interesting part is that while volatility has returned to the levels we saw in March, we haven't yet seen that kind of explosive volatility that is associated with a crash. I intentionally captured the 2020 event here, where we had the VIX shooting up to the 80, 90 level on the upside on an intraday basis. And while this, like you were saying, the selling is occurring, we aren't really crashing. And that's actually the difference of this scenario. This is a methodical bleed more than it is a crash. And that really, to me, can be looked at two ways. One, we're not going to crash in this iteration of the sell-off, and that this overhead resistance at around 35.40 on the VIX will house the short-term swing high of this swing down on the market. Or the other question is, what if this thing does just accelerate and start to crash and we finally have a breakout above that VIX? Obviously, predicting a market crash is always a low probability event. On balance, the markets tend to bounce much more often than tend to crash. And so you can't assign a high probability of it, but it is a very vulnerable moment. And considering the weakness and the poor sentiment, there's a lot of things to be nervous about.
Patrick, I want to pick up your point about a methodical bleed of equity prices without a crash. Now, what that says to me is human emotion hasn't gone out of control yet. It seems to me like this is institutional reaction to changing monetary policy, the recognition that inflation is likely to constrain the Fed's ability to fight inflation and so forth. That means that institutional traders are doing their institutional thing, which is not panicking, but just accepting prices going down and continuing to sell into them in a slow and methodical pace. What happens when retail freaks out and all of the people who were convinced that stock prices can only go up suddenly panic? It seems to me like that moment hasn't come yet. I can't think of a reason that it wouldn't come unless we get a complete bottoming and reversal pretty darn soon here.
Eric, it's certainly a very interesting moment in the markets, and your point is made. I mean, really, the one thing that I think we have to just leave it at is the fact that the prevailing downtrend is still currently dominant, and we have to respect that. And really, now that we've given out supports, there really is this air pocket of space where all sorts of scary, volatile things can happen in both directions. By the way, it doesn't have to just be all down. Well, I think the best way to leave it is that all of our listeners need to strap on the seatbelts, because the day in, day out volatility is only going to be more and more intense at this stage.
I couldn't agree more, Patrick. And again, we haven't seen panic yet. What you're seeing now is a methodical sell-off. Let's move on to the dollar index on page 5. I said before I wasn't sure whether it was a 20-year high. It looks like it's maybe a 19-year high as I look back on your chart, which goes back further than mine does. What do we make of this? And how long, considering it's been 20 years, how long do we need to stay above that line in order to confirm this breakout, which would tell us that there's quite a bit higher to go still?
Well, I mean, that's subjective. This is a monthly chart, so I guess if you were utilizing a monthly chart basis, you would at least want to see the monthly close happen above that level. But I don't think that alone is it. To me, it's going to be about the price action itself. The reality is that the yen has not participated in this, but the euro made the big breakdown. And with the euro and the pound sterling so weak, if the euro here was heading down to parity, and we see this kind of weakness persist, then this dollar uptrend is certainly going to be confirmed. And considering the dollar index is weighted so heavily to the euro, this is really going to be about a call of whether the euro is destined for a trip below parity. And that's a bigger question I think I want to analyze over the coming weeks. It's certainly not one I'm ready to stick my neck out on today. With that said, Eric, Let's talk oil. And you were absolutely right in the market wrap when I was saying that, it's certainly not lacking volatility, but it's lacking directional volatility. We've more or less stayed within the same range for 2 entire months. And while it's been a pretty wide range, the ping pong match from support to resistance is persistent here. And the one thing, though, is that in this kind of huge risk asset deflation cycle we're seeing, where almost nothing is safe in the commodity markets and nothing is safe in the equity markets, crude oil is really not. It has been able to hold up relatively well. And I asked the question there is that, well, if once we see some sort of a short-term tradable low, does that mean oil leads the way out of it on the upside? It's a really interesting question that we're going to be watching technically to see if that emerges.
My prediction, Patrick, is volatility will increase for sure here. And in terms of direction, I think ultimately it resolves higher. But boy, there's plenty of room. If we see that emotion come into the stock market and we get an outright crash and everybody finally wakes up at the same time together and says, oh my gosh, it really is a recession coming, which I think has been clear for a long time now. When everybody figures that out, there's lots of room for, I'll call it old school wisdom, to say, oh, if there's a recession coming, oil prices have to go down dramatically, 10 or 20 bucks. Lots and lots of speculative longs will liquidate their positions, believing that it's a certainty that recessions have to cause oil prices to go down dramatically. I don't think that those people will be considering that it could be the market is seeing that higher oil prices are coming, and that might be one of the reasons for the recession to begin after all, because the cost of energy is going to have a defeating effect on the economy. And if you look at what's going on in terms of policy by the U.S. government, as well as the escalating conflict between the superpowers, I think there's lots of room for an upside resolution well above the 130 high, or 131, whatever it was that we set that Sunday night right after the war broke out in Russia and Ukraine.
Eric, just on page 7, I had that copper chart, and I really just wanted to reference that as a point to that oil chart, which is the entire commodity complex has been distributing, and it was really oil has been holding up. And whether you're talking iron ore, the basic material names, the uranium names, there's nothing safe right now. And copper here is now trading down to a multi-year low at the bottom of that consolidation. It'll be technically really interesting to see whether copper can actually bottom and base along that level. But Eric, what I wanted to though move on to and talk about is bonds. And so just as a reference point, I wanted to on page 8 show the bounce in the 10-year Treasury note as that 3% yield that we're back down below it on the 10-year yields. But what I wanted to really reference that to is looking at the high yield bond junk ETF on page 9, which continues to get hammered lower and has not reacted as Treasury bonds have bounced. And so what that usually reflects is, like on page 10, that the credit spreads are starting to widen. And this was one of the things that me and you talked about over the last 3-4 months, talking about when will we start seeing the cracks in the corporates, and whether investment grade or in junk or high yield, these high yield markets, when will it start to reflect that these companies are bigger credit risks and need a premium there? And we're finally seeing that, and I think that's being reflected in the stock markets here.
Patrick, this chart jumped off the page when I saw it in the deck, and the reason is, as our long-term listeners know, how many times did we predict or analyze and say, boy, the junk bonds are so overvalued, they have to eventually crash, and we tried to make that call, and we were just way early and got it wrong and ended up having to cover our shorts at a loss. Well, okay, the big sell-off in junk that we predicted several years too early seems to finally be happening. I doubt that it's over yet. And remember, junk spreads used to be like 10 or 12%, like 1,000 to 1,200 basis points above Treasury yields back in the good old days before everybody decided that low interest rates pertain to everything, including credit that's not likely to be paid back. It seems like that's changing, and the price of junk is coming back down to earth. If this continues, I think it's a really strong sign. Listeners, if you enjoy Patrick's chart decks, I know I sure do, you can get them every single day of the week with a free trial of Big Picture Trading. Get the information on page 11 and 12 of the chart deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.